Welcome to Alpha Recap, your quick, smart rundown of the market day. I'm glad you're with us. Today we're looking back at market action from May 1st. And as always, if you have questions, you can reach us at stockalpha.ai.
Thanks, great to be here. There was a lot packed into the session. Earnings really drove dispersion across the market.
Right. Let's start with the big picture headline. Markets closed modestly positive. The Nasdaq finished up about 0.4%, and broad ETFs were higher too. The S&P 300 ended the day up roughly 0.3%.
Exactly, but that calm headline masks the real story. Earnings-driven moves created big winners and losers beneath the surface. So what really stands out here is the degree of dispersion.
Let's dig into that. Atlassian had one of those big idiosyncratic moves. The stock finished the day up about 20 to 29%, depending on which intraday print you look at. James, why did that matter?
Atlassian beat on cloud and data center metrics, and the market reacted fast. It's a good example of how a clear signal of durable cloud demand can flip sentiment, especially for software as a service names that had been under skepticism. When revenue quality or net retention looks better than feared, multiples can re-rate quickly.
So in plain English, when Atlassian showed better cloud usage, investors treated it like proof that customers were still spending on software and the stock jumped.
Yes, absolutely. And that matters because many models had baked in slower cloud monetization. This kind of beat forces analysts to reconsider long duration cash flow expectations.
And to riff off that, the debate between a broader SaaS downturn versus selective recoveries got louder today. Some analysts remained cautious, while others saw Atlassian as a potential turning point.
Right. And the other thing is, even if Atlassian is idiosyncratic, it signals that proving cloud demand can offset the so-called software apocalypse narrative.
Let's pivot. Energy names also grabbed headlines. Exxon reported first quarter earnings per share of about $1.16 and roughly $85 billion in revenue, with production around 4.6 million barrels of oil equivalent per day. Chevron also posted upstream strength that beat expectations.
Those reports reinforce the theme of cash flow resilience in the integrated majors. Upstream execution, meaning actual production volumes and realized prices per barrel, drives free cash flow, and that cash supports dividends and buybacks. For income-focused allocations, that was an important data point.
So the takeaway was that energy was delivering cash that matters to yield investors, even as oil prices remain volatile. Noted.
Exactly. I mean, when you step back and look at this, the majors are showing operational steadiness that changes risk-return calculations compared with other dividend payers.
We can't ignore the microcap drama. CHSN plunged about 15% to 3 cents on volume of roughly 155 million shares. Meanwhile, FGIWW jumped about 67% to 6 cents, but that was on only about 6,800 shares traded.
Those are textbook microcap moves. Percentage moves look dramatic, but absolute dollar exposure is tiny and liquidity is thin. Traders should be aware that the volatility is structural, big swings on relatively little information.
Yeah, that tracks.
And there's another layer, short interest concentration. Names like Sphere had short interest around 137%, Telesat about 54%, whereas Alphabet was near the low end at about 0.1%. Those concentrated shorts create both squeeze risk and continued downside conviction.
Hold on, say that again. 137% short interest? That's wild.
Yes, it flags extreme positioning. When short interest exceeds 100%, it usually reflects loan dynamics and can presage rapid moves if sentiment reverses.
Switching gears, there were a couple of structural stories in hardware and software. SanDisk and Salesforce showed developments that could change how analysts value those businesses.
Right. SanDisk's move toward long-term hyperscaler contracts suggests a shift from cyclical hardware revenue to more contractual, predictable cash flows. And Salesforce is revising revenue presentation for fiscal 2027, which affects comparability. When companies change reporting, growth and margin math can look very different.
In short, contractual revenue can convert a lumpy business into something closer to recurring cash flow, and accounting changes can obscure like-for-like growth unless you adjust your models. Seriously important for growth investors.
Exactly. Growth investors should be explicit about revenue quality, cloud monetization, data center demand, and the degree of contracted revenue, and update models for any reporting changes.
There was also an interesting regulatory thread. Morgan Stanley reiterated an overweight on Grab despite Indonesia's proposed commission cap. That underscores a debate. Do policy moves meaningfully impair platform economics, or are they manageable hiccups?
It's a classic tension. One camp treats commission caps as durable margin headwinds. Another views them as manageable shocks that won't destroy the marketplace fundamentals. Analysts and investors have to price policy risk into valuations appropriately.
Quick reaction segment. Right.
Yeah.
Okay, let's talk implications by investor type. For income and dividend investors, the energy prints from Exxon and Chevron supported the idea that integrated majors can keep distributions intact, at least in the near term.
True, but they should still watch commodity cycles and execution. No single quarter eliminates price risk.
Growth investors got a reminder that selective SaaS names can re-rate, but they need to account for reporting changes like Salesforce's. Value and cyclical investors saw SanDisk move toward contract revenue, which could alter valuation multiples if sustained.
And traders and active managers saw one of those environments where dispersion creates opportunities, but also heightens execution and liquidity risk, especially in microcaps and names with concentrated short positions.
Let's cover a few smaller but interesting items. There was a cannabis export signal. A company shipped its first international gummy order to Australia and recognized about $350,000 in revenue. For a tiny market cap firm, that's notable, but the bigger story is export capability copying beyond the big Canadian producers.
Right, it's a signal rather than a game changer. Small players participating in export flows matters for industry structure, but large country export volume still centers on major producers.
Okay, strategic watch list. What should listeners keep an eye on in the near term?
First, the earnings cadence. Watch upcoming reports to see if the Atlassian outcome is isolated or part of a broader software rebound. Second, monitor reporting and accounting changes like Salesforce's fiscal 2027 update and update your models accordingly. Third, track short interest and microcap volume anomalies. And finally, watch regulatory moves. For example, Indonesia's commission cap for Grab and macro flow indicators like ETF breadth and volatility measures.
Great checklist. Before we wrap, give us the concise takeaways, 3 quick bullets.
1. Markets closed modestly higher, but earnings drove elevated dispersion. 2. Atlassian's rally showed selective SaaS resilience, while energy majors delivered cash flow signals supporting dividends and buybacks. 3. Microcap volatility and concentrated short positions created risk and trading opportunities, so position sizing and liquidity awareness were essential.
Solid. Remember, this analysis was informational only. Analysts note market moves and data. This is not personalized advice or a recommendation to buy, sell, or hold any security.
Yes, always an important reminder.
All right, final note. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening. We'll be back with more recap and context after the next market session.
Thanks, James. And thank you for tuning in to Alpha Recap. If you want to follow up, stockalpha.ai is the place to go. And don't forget the live Q&A feature. See you next time.